Yes, give it up. Let's go. Discussing how the XRPL is powering the next phase of adoption. Please extend a very warm welcome to the CTO of Ripple, Mr. David Schwarts, and our moderator, Ben.
Amazing. Great to be here. Great to be here with David and all of you guys specifically. Thanks for coming. Man. So before we start, I would say, David, we talked already, but I would love to hear some Vegas jokes from you.
You know, I love coming to cryptocurrency conferences in Las Vegas. It's just such a great city. I have a special connection to Las Vegas because my parents went to Las Vegas when I was younger. They left in an $18,000 Toyota Tercel. They came back in a $350,000 Greyhound bus. So, no, but seriously, I love cryptocurrency conferences in Vegas. I just think that there needs to be something in Vegas that appeals to people who are good at math. All right, that's enough. Maybe we'll save time for like a pirate joke. No, don't.
So, yeah. We definitely wanted to touch on XRP Ledger and the next phase of adoption, so this will be themed in that. David, from your point of view, why are institutional adoption is such an important focus, not only for the industry, but also for the XRP Ledger as that stepping stone?
I think the big thing is, I personally believe that DeFi is going to replace most of TradFi. I think people are going to get most of their financial services from decentralized blockchains. And I think in order for that to happen, people need to get the services they actually need from those decentralized blockchains. Today, we can provide essentially gambling and speculation and yield farming and collectibles, which are great. You know, the internet started with use cases like porn, and that's great to grow a technology, but like that, obviously that's not going to be DeFi replacing TradFi. For DeFi to replace TradFi, people have to get from the layer one blockchains like the XRP Ledger, things like payments and checking accounts and savings accounts and investments and loans and all of the things, the boring, not super sexy things that make up a $20 trillion market.
Right.
And so institutional adoption is what's going to pave the way for layer one blockchains like the XRP Ledger to be able to provide those services.
And what is the difference between, let's say, the prior years of institutional adoption and the newest trend or wave of institutional adoption that we are seeing?
I think the biggest transformation is the institutional adoption that we're seeing now and that we hope to see over the next year is going to bring customers on-chain. So this is just like anything else, like building an app is a great way to make money because there's millions and millions of people who are one click away from using your app. The fact that you have a target market that can use your product if it meets their needs, they can try it out. They can see if they like it. If they like it, they can tell their friends about it. You have to have a target market. The problem right now for a lot of blockchain systems is that there's no the target market doesn't exist. It's like if you build Twitter in the year 2000. There's nobody who has a smartphone. There's nobody with home internet access. Even if you had customers who would like your service, they can't use it. So I think that critical feature is going to be that this next wave of institutional adoption, stablecoins are a great example. There's nothing more institutional than a stablecoin. You know, Ripple launched a stablecoin. It is heavily regulated. USDC, these are heavily regulated products. Most of us will never be able to do business directly with the issuer to get the stablecoin from them, right? There's other institutions that go to Circle and go to Ripple and they get USDC and RLUSD. But what happens is we have these giant DeFi ecosystems where the stablecoin is used as collateral, or the stablecoin is used for payment, or the stablecoin is used for all kinds of different things, right? There's been massive growth in the DeFi space because of stablecoins. So I think that's the pattern for the new institutional adoption. If I didn't give you another example, you'd think that like I was crazy, like maybe, yeah, there's stablecoins, but what else is there? Well, think about tokenized securities. Think about tokenized treasuries. These are things that lots of people hold as investments, tokenized stocks. These are things that people need, and the institutions have to create them. They can't come from inside the DeFi space. We can't create sensible real-world investments. Well, we can in limited quantity, but we can't create them in the same quantity that TradFi can. So the fact that these institutional DeFi use cases, these new ones, are going to bring onto the chain the things that people currently need to get from TradFi, and they're going to create a target market for the next wave of retail DeFi so that you will have customers who have blockchain access.
So basically, it's very necessary for that to go from the currently, let's say, 100 billion stablecoin market to, let's say, 10 trillion, 5 trillion, 16 trillion market that is out there in real-world assets.
Yeah, so I think there's two key blockers. One of them is that in the DeFi space, we have a very limited set of offerings.
Right.
NFTs are great, but they're not going to replace TradFi. Over-collateralized loans, great, not going to replace TradFi. Being able to buy and sell speculative assets like cryptocurrencies and yield farming, those are really cool, but they don't have the kind of mass appeal that we need. And I think the other blocker is being able to get money on and off chain. So like I can get money off, I have enough money that I can put money on a blockchain and use it, but like if I didn't have huge savings, if I didn't have huge investment funds, that wouldn't be realistic. So like if we want to target, we can target maybe 0.1% of the global population with a system where you have to move their money from where you can spend it onto this blockchain, and then it's hard for you to get it back. So I think we need to solve those two problems. I think this wave of institutional adoption is going to solve those two problems. And that's going to enable that next wave of DeFi mass adoption, hopefully maybe as soon as next year.
Yeah, because currently a lot of the use cases right now are some sort of gambling and some sort of these things, very speculative.
Because they're easy to build inside our ecosystem. Yes. It's the same thing with the early days of the internet. Like porn was a big use case because it's easy to build inside that space. There's demand, it's not satisfied very well. Like really crazy speculative assets were very hard to get to before cryptocurrency. There was no asset really, maybe penny stocks, like there wasn't that kind of, and NFTs, like those markets didn't really exist. And so there was low-hanging fruit, but it's not going to get what's going to get us mass adoption.
Do you see any other blockers currently? Because regulation was like always a big one. Now with this new administration, how did that change from your point of view?
Well, I mean, that was obviously that was huge, especially, putting my Ripple hat on for a second. I mean, dealing with regulation was a huge blocker for us. And I think there was a lot of institutions that, we had to sort of hide the cryptocurrency aspect of what we were building to get institutions. In the early days, we were like, forget about cryptocurrency, you'll never have to touch it. And then later on, we're like, well, are you willing to use a cryptocurrency where it will save you money? And they're like, well, if we can, we will. And there was all kinds of regulatory blockers. So it's nice that those are, that's becoming easier. I think that's what's going to enable this next round of like real world asset adoption. Also, you might think, well, it's really just the United States that changed, but that's not true. The United States, through many formal and informal means, has a tremendous amount of control over the global regulatory environment. There are many countries who won't do something if the United States disfavors it, and so we're starting to see, very, very quickly, we're starting to see things change. So I think that's going to be great, especially for institutional adoption, which we need.
Yes. So looking at the XRP ledger and the functionalities that it provides, thinking of decentralized identity, permission domains, these functionalities, can you expand more on that and how that maybe is actually giving these tools to enable that shift from not only the stablecoin issuers, but becoming this huge market, investable market, also for the XRP ledger?
So the XRP ledger is not a smart contract or Turing-complete blockchain like many hundreds of other blockchains are. That's an advantage and a disadvantage, and obviously what we want to do is we want to play to its strengths and avoid, trying to compete in markets where the disadvantages, work against us. It's very differentiated. And so that means that if we want to tackle these new use cases, there have to be curated smart transactors that serve those use cases. So there will be smart transactors specifically for lending use cases. There'll be smart transactors, that optimize for real world. That's why we introduced the automated market maker feature. We added a smart transactor for NFTs. So there are these curated smart transactors that enable these specific use cases. They're not going to be able to target 100% of use cases because some use cases will require functionality that the smart transactor just doesn't provide. But there's a significant number of advantages in areas like performance, fee stability, and most importantly, I think everybody has heard the story about somebody who agreed to a smart contract. All my apes. Anyone remember All My Apes Are Gone?
Yes.
Right. So like
Yeah.
someone thought a smart contract was going to do one thing, they agreed to use that smart contract and it did something else. And the problem is your wallet can't understand every smart contract. And there can be flaws in smart contracts. Because the XRP ledgers transactors are more curated, there could be a flaw in a smart transactor, but that's going to affect everybody in the ecosystem. As happened with the AMM,
Yes.
if we find it, we fix it very, very quickly. Whereas in other ecosystems, there could be hundreds of smart contracts with many different flaws that may or may not get addressed. So it's an advantage and a disadvantage, and you're going to see more proposals for smart contracts from smart transactors from Ripple and others to target the use cases that we think are going to be dominant. I think what you're also going to see is, we made a commitment to work on some programmability. I don't think you're ever going to see the XRP ledger become yet another Turing-complete smart contract chain. If you want those, you know where to find them. I think there's room for a differentiated product that has a more curated set of features. But there'll be a number of cases that the XRP ledger could almost satisfy, where there's some additional thing you need that doesn't necessarily trigger all of the disadvantages of full smart contract capability. Like one example might be, you have an NFT marketplace and you can do something more complex on the back end with the funds. That doesn't affect the person who's doing it knows they're buying or selling an NFT, they know how much they're going to pay, they know what NFT they're going to get or give up. We can have more complexity on the back end without sacrificing the security features. So I hope you'll see that kind of growth.
And I think we have also seen that 70-80% of the functionality with fixed functions and smart transactors goes really a long way. Like people can do very much a lot with them. And for the rest of the 20% that you cannot do, there is maybe another solution.
I think there's other advantages too. Like for example, if you look at a blockchain like Ethereum,
Yes.
there's a number of different things that provide a swap functionality, and they all have their own isolated liquidity. And that's nice if you want to own a pool of liquidity where you can tax it. And some people want that, and they won't be able to do that on the XRP ledger because the XRP ledger doesn't allow some particular party to own and control a pool of liquidity, whereas Ethereum does. Ethereum doesn't stop you from doing anything. But there's advantages to having a blockchain where all of the liquidity is open to everybody, where it's not restricted in that way.
Is that basically the be your own bank mentality that everybody actually always talks about?
This is one of the most ironic things for me, because I really drank the be your own bank, no middleman Kool-Aid in the early days of the space. And everybody comes to me and is like, how can I be somebody else's bank? How can I be a middleman in someone else's transaction? I'm like, no, we built a system where you can't do that. And it creates an interesting paradox, which is it's great for the users, but it's harder for people who want to build on it to if you launch a swap functionality on Ethereum, you can issue a token and you can monetize that. You can't really monetize a liquidity pool on the XRP ledger belongs to the world. It's a public good. That's an advantage for the people using it, but if you're trying to build your own fiefdom, you can't really do that. And so again, it's a differentiator, and for some people it will be a disadvantage. But like I said, I think there's room in the market for something that has this unique combination of features. It provides more predictable fees, more concentrated liquidity. It's going to have more curated enterprise DeFi functions, and hopefully it'll be able to carve out a nice big chunk of the market.
I have to be honest, it made me super proud because there was the pitch event we had with EZA and a lot of other builders here who joined. Thanks, by the way. And pretty much all of them, their pitch was, we want, with their solution, to cut out the middleman. Was it in pharmacy? Was it in commodities trading? And it was really awesome because that's the way to do it. And they cut out the middleman and had immediately a great product, but just by cutting them out.
Or did they make themselves the middleman?
So
very often, someone who says we want to cut out the middleman means we want to replace the middleman with us. Right? Uber, we're going to cut out the middleman between the consumers and the drivers. Well, no, you don't want to cut out the middleman.
Are the middlemen that we talk about typically also in traditional finance? Do you see these people are actually lashing on blockchain, or do they want to defend their position like the incumbents? They say, no, we want to stay the middleman.
I think we see both. I think if you go to the market leader, they try to defend their position, they try to put pause on technology, and they try to convince you that they're looking into the technology and they're experimenting with it, but they really Sony could have made the iPod in theory, but they didn't, right? Apple did, because Apple had no position in the music industry. You would think Sony needs to defend their position in the music industry, they better innovate, but that's not how they think. They think that they can pause innovation. But you could imagine an alternative world where someone at Sony had the foresight to say digital music is going to happen, and both of those usually it doesn't work that way. Usually it's the smaller, more aggressive company that disrupt. Like if you look at how tech took over retail, it wasn't Walmart, right? It was Amazon. If you look at how tech took over any number of fields, it's usually a younger, more agile company that doesn't have as much to lose. So what we've found is like if you're doing something in the credit card space and you go to Visa or MasterCard, there's going to be a lot of pushback and resistance. But if you go to American Express or Discover, they're more aggressively trying to get markets. I'm just picking those companies just as arbitrary examples. I'm not, I'm not saying, you understand what I'm saying. Like, we notice the same thing with banks. When we go to the very, very biggest banks, they just want to be able to say they're doing things. They want to be able to say, no, we're not going to we're not going to lose our position in the market. We're going to be aggressive and innovate. But they don't really want to do that so that's why, like, one of our early partners, Santander is a bank that was big enough to matter, but not so big that they didn't want they were aggressive.
So right at the...
Exactly, and so that's the threshold point that you want. You want to find those companies. One of the other things that we noticed is like, it helps if you don't have to sell them on your vision. So in the early days of Ripple, we didn't try to sell people on our vision. We just said, hey, we can make your payments faster and cheaper. And then why would you not want that? And we noticed some of the same thing with tokenized real-world assets. We don't go to companies typically and say, this is going to change your entire ecosystem and how you do business. You're going to reach customers directly. If they're receptive to that, great. But sometimes the sales pitch is really just like, this is going to be cheaper. Like, weirdly, in the tokenized real-world asset space, you know what's one of the biggest selling points to institutions? It's easier to audit a public blockchain so currently, one of the problems these firms have is they can turn over their records to an auditor, and an auditor can say, this is great, all of these records are cool, thumbs up. The problem is, how do they know that the records that they were given are all the records that there are? Obviously, if you had something that you weren't supposed to be doing, you wouldn't necessarily hand it over to an auditor. If you do something, and because of this, they tend to have to employ third parties to hold the records. So in theory, the third party wouldn't conspire with them to hide something from the auditor, so the auditor doesn't go to me, who they're auditing, they go to my third party, and that costs them a lot of money. And so with the blockchain, they don't need a third party. The blockchain is the third party, and there's no proof of absence problem. You can't hide transactions on a public blockchain. And weirdly enough, that's like a huge, they look at it like, that's not, we're going to them, that's a huge change in the way they do business. It's mind-blowing. To us, that's like, is that even interesting? Like, why does that? But no, they're like, no, you've actually solved a huge problem. And the other thing is like, the microscopic savings is massive because if you think about tokenized treasury, you might think, well, it's hundreds of millions of dollars. Yeah, but the person who holds the tokenized treasury is making 2%.
Right.
And the company that issued it is making a right? Like if you can shave a couple of basis points off their costs, that's a massive competitive advantage.
Is that only matter? I love that example. It doesn't only matter for countries and places where there's good infrastructure already, or also poorly served countries.
There's some advantages to both. So for one thing, in countries that are well served, it's easier to onboard customers, it's easier to pay out, it's easier for them to use their blockchain assets. So that's good.
Yeah.
In countries that have less infrastructure, if you can provide some ability, like even if it's just really easy to pay your rent from this, or it's really easy to do something from it, then that helps. One of the challenges, though, is that in areas that are not well served by the current financial system, the incumbents there don't want them to be well served by the financial system. Like if you think about companies that can hand cash over the counter,
yes,
right? Like Western Union has a massive network that can hand cash over the counter. That's only valuable if that place has a cash economy. So they don't want, they theoretically, like in principle, they don't really want like people to be able to easily make electronic payments, because once it becomes an electronic payment world, cash over the counter becomes less valuable. So it's kind of challenging. So again, don't go after the biggest incumbent who has the most to lose. Go after somebody a little bit smaller who would want to negate the competitive advantage. One of the things that we discovered early with our payments business is like, don't go after the company that just spent $5 billion optimizing their treasury operations. Yeah. Go after the company that doesn't want to spend $5 billion to optimize their treasury operations.
On this, David, for a lot of people in crypto, one of their motivation is, I want to have a system that cannot be censored. I'm in control of my funds. Like the libertarian view, early Bitcoin. And that is typically only seen for the retail sort of people. But that actually also applies to banks and institutions because they are suppressed by the bigger guys, right?
Exactly. Yeah. So one of the things that we discovered is people will be like, oh, the financial system is biased in favor of the big banks who control and run everything. But when most people say that, they assume that like every bank is a big bank. But like if you go into a most banks are not big banks, right? There's thousands of banks, and the number of big banks is, really big banks is a couple dozen, right? And so those companies are trying to, so one of the things that we hear a lot is like, why would somebody use a public blockchain when they could just like when a bank could build their own? Because in practice, that would be the biggest banks who would be building it, and all of the other banks are now reliant on their competitors' infrastructure, which is exactly what they want to get out of. So weirdly, that argument resonates at levels where you wouldn't expect it to resonate. Obviously, it's not going to resonate with like the very biggest banks in the world, because they are trying to do capture, whether regulatory or business. Like one of the reasons we targeted Swift early was because they were very much captured in leading, they're a messaging system, but the liquidity and the actual payments were being done by the very, very large banks. And so they were kind of capturing people in that system. One of the first things we discovered is we said, hey, why don't you use cryptocurrencies for payments? Like, we can't because our messaging system makes it as difficult as possible to do that. And I don't think that was an accident. Like, it was built and owned by the companies that are providing like traditional Forex liquidity and so on.
And I see like a lot of these news from either these bigger banks or you mentioned Swift and other providers that pilot private networks and do experiments with that. And I was like reading one of the posts from, I think it was a researcher from Bitwise that does an ETF, and he said there was previously a conversation between public and private. That conversation quietly settled. Public is the way. What are you thinking about that?
I totally agree. But what that means is that there's going to have to be interoperability, and there's going to be a lot of successful public blockchains. I would love to see a world where everybody does everything on the XRP ledger. I don't think that's realistic. Just like I don't think having one successful internet company is realistic. I don't think having one successful anything is realistic. I think there's going to be there's going to be an ecosystem out there, and I think interoperability is going to be critical. I think the reason private blockchains didn't really win out is because they just don't really solve, like somebody has to run them, and then you don't really get the benefits. I think it's surprising how well it resonated across all levels, even institutional, this idea that this isn't controlled by my competitors. If you're a big company, sure, then I'm going to run the private blockchain, I'm going to control it, and everybody's going to come to me and kneel at the king. But if you're anybody else, that's obviously not them, especially if it's your competitors. And that's especially true in the banking industry. Like, I'm sure many of you know about the crackdown on banking for like marijuana-based companies and firearms companies and legal pornography and to some extent a lot of cryptocurrencies companies. And that pushback came to the point where I think we saw very publicly, like even banks who wanted to bank those totally lawful businesses in effect could not, because the system, the government was very much a part of it, but the larger banks were a part of it as well. Like the larger banks were very much a part of making sure that even if a bank's like, it's legal for me to bank these people, I'm going to do it. And their counterpart is like, well, you're taking on too much risk, and so we're not going to facilitate your payments, and you can't be a bank by yourself.
Yeah.
So I think this idea that it's going to be run by the big banks is like something that the small banks didn't like anyway.
And because you mentioned also in the beginning about adoption, how it's very similar to the internet and all this, we also noticing right now everybody has their own private internet. It's one, public internet, and then you build privacy and security on top of that layer, right?
Yes.
So this way is what people.
And even the places that were very motivated to look at China.
Yeah.
China would really have liked to have had their own internet that was as isolated from and they tried that. And what basically happened is they faced a take it or leave it situation, and they had to take it.
Yeah.
And I think very similarly, like when you're over here and you have a wall that you don't have to have, and all of the people you want to do business with are on the other side of the wall, the temptation to knock that wall down. And I think it's been very successful. My philosophy has always been build a system with the wall and give the person a button to push to knock the wall down, and let them watch as they're turning away business and turning away. And at some point they're just going to be like, and they'll push the regulators, right? Even when there's regulatory obstacles, like they'll push the regulators. It helps. It's hard when we go to the regulators on behalf of our customers, but when our customers go to the regulators, that works a lot better, particularly internationally.
The more advocate for it, the better.
Exactly. Yeah.
XLR, speaking of interoperability, XLR is something that comes to my mind for the XRP ledger that a lot of people waiting to get like the interoperability between the XRP ledger and a bunch of other blockchains. What is making it so difficult to get that interoperability, because it's a multi-chain world, right? Why not just put everything together and,
It's so hard. There's a couple of reasons why interoperability turns out to be harder than you might think. And I honestly, until fairly recently, I was kind of giving up on the space and being like, oh, this just seems so frustrating because every time we solve one problem, another problem pops up. And we solve one problem, another problem pops up. But I got much more positive when I noticed that the problems that were starting to pop up were actually a lot less severe than the problems that we were popping. I'm like, hey, wait, this is actually progress. Like, we have the same number of problems as we had before, but the problem isn't like this one thing goes wrong and everybody loses their money. It's this weird edge case that the governance doesn't handle very well. Well, that's a lot better. So there's a couple of core reasons why it's a problem. One of them is that layer one governance on a decentralized blockchain, whether it's Ethereum, whether it's the XRP ledger, whether it's Bitcoin, is fundamentally based on the fact that you can't steal anything from a blockchain. You can't steal Bitcoin from the Bitcoin blockchain because there's no place else it can be. You can't steal XRP from the XRP ledger. If I found some way to make the XRP ledger say that I have 100 billion XRP, everybody would be like, well, damn, that's annoying. Like, we're gonna have to fix this. We can't use the XRP ledger until we fix it, and validators will have to get together. But until they do it, the ledger would be broken. I wouldn't be able to put that 100 billion XRP somewhere to have for later, and presumably exchanges wouldn't let me cash in. You can't steal RLUSD or USDC. If I found some way to make Ethereum say I have $1 trillion USDC or the XRP ledger say I have $1 billion RLUSD, I'd be like, man, that sucks that we can't use these blockchains to move these stablecoins. But nobody's giving me the dollars, right? Circle is going to be like, oh, sorry, we have to give David all this money. That's just the ledger, right? It won't work. So you cannot corrupt a layer one blockchain's governance to just steal other people's money. It's impossible. But you can on a bridge.
Yes.
You can on interoperability. So let's say there's a bridge that enables Ethereum on the XRP ledger. If someone moves the Ethereum on the Ethereum, there's nothing that anybody in the XRP ecosystem can do to get that Ethereum back. It's just gone. And that's a very, very different kind of problem. And so the problem then becomes that, like, the bridge is holding your money. And if somebody's holding your money and they're not making a lot of money doing it, they're very incentivized. If you're holding $1 million of my money and you're making $50 a year, you're very incentivized to run off with my $1 million. If you're holding my $1 million and you're making $100,000 a year, you're pretty incentivized to keep my $1 million secure because your business is very valuable. And if bridges are making a lot of money, then they're expensive to use. And so we want interoperability protocols to be cheap, but we want them to be secure, but they're guarding our money, and it's just very challenging. Like I said, I'm optimistic. Newer technologies like zero-knowledge proofs are improving our ability to build better bridges. Axelar is a best-in-class bridge. There's a number of other. Wormhole they're very good bridges. I just warn people to just be sure you rationally consider the risks. There are risks with interoperability, today's interoperability tools and bridges, that don't exist with layer ones, and just make sure you understand them and rationally evaluate. I wouldn't tell you not to use them because of the risk. Look, credit cards cost 2%. Like, every time you use a credit card, you're losing 2% of your money. That's equivalent to a 1 in 50 chance of losing 100%. That's equivalent to 1 in 50 times you use a credit card, they just steal all the money. So, like, clearly, like, these bridges are much less terrible. Like, 1 out of 50 times they don't steal all your money. They're way better than credit cards. Like, they're very usable. But you should understand and evaluate the risk and understand that, like, everybody in the industry is working to make it better.
I mean, you spoke of losing risk. You're in Vegas, so many people.
Well, yeah, you guys are here in Vegas, right? You gamble, so yeah, go for it. What the hell?
Probabilities.
I hope you do really well.
So one thing I want to also touch on is maybe from the community, maybe 1 or 2 design choices that you have seen by the XRP ledger that you took the advantage, knowing that there's also a disadvantage in having that feature, like some trade-offs.
Yeah, engineering is filled with trade-offs, right? Yeah. And we made a lot of decisions in the early days of the XRP ledger. Some I think were good. Most I think were pretty good. Some I think might do differently if we had the decision to make today. A couple of big ones. One is to build it around an order book. So an order book is a very efficient way to provide liquidity. It can generally be much more capital efficient than an AMM, but it requires a lot more transactions. And in fact, a significant fraction of transactions on the XRP ledger, say probably more than 90%, are just people placing and canceling offers. So I think that's an interesting trade-off that you have that ability to let people place offers and use it like an order book with very conventional trading. But there's a disadvantage in that it creates a sort of flux of orders being created and canceled that an AMM, wouldn't have. I think another early decision we made that was very controversial, when we built the XRP ledger, UTXO models like Bitcoin were the only, but there were no such thing as accounts, right? We built accounts as a thing on the XRP ledger. They're very powerful. They let you do things like if you're a charity, and let's have a charity and I hire him to like turn my XRP into dollars, but then I want to hold the XRP myself. I don't have to change my receiving address like I would with Bitcoin. I could just change the signing key so he doesn't have it anymore. You can set properties. You can change security parameters. You can set what assets you're willing to receive in payment. But in exchange, we have this reserve because accounts are heavy and expensive, and so we have to ration them. And so that's an advantage. And of course, the overall architecture of not using smart contracts. Vitalik tried to convince Stefan and I way back when to build smart contracts with the XRP ledger, and he didn't convince us. And obviously, there's a market for smart contracts.
Yeah.
Like you can imagine an alternate universe where he did persuade us, and the XRP ledger is more like Ethereum, and maybe Vitalik wouldn't have gone on to build Ethereum. I mean, who knows?
But being differentiated, I think, is a good way.
Definitely. You don't want to be another one of the hundreds of.
Well, fantastic. Thanks, David. It was an awesome conversation, and thanks everybody for listening.
Thanks, everybody.